So yeah, it is 1 month. We have to remember that it has been consistently coming down. It was surprising to us. I mean, it was very concentrated in some of the white collar jobs in finance, business, education. It's going to be more important on how that translates into Friday's number, if it does at all. The one thing we took out of that report is the quits rate. So that's the amount of people that are voluntarily leaving their job, and that still is very low. So that shows that there isn't a ton of confidence in the future of the labor market. People are holding on to their current jobs. Let's just see what happens on Friday. We've already been in the camp that there's more of a chance the Fed will have to raise rates at least one more time this year. Whether it's November or December really will depend on the data that's coming in. Right now, we do see, the labor market in its entirety is still relatively strong. So the Fed can't necessarily pull back what they're doing. The other thing that has concerned us has been the fact that oil prices are back on the rise. So that's going to cause some volatility in the inflation data and make the job for the Fed even more difficult.
You also mentioned in the JOLTS report, there's an layoffs also stayed low in addition to quits. And looking ahead then to Friday with the jobs report, I mean, where do you see the weakness coming from? It looks like people have been calling for the hiring to be slowing, and it is slowing, but I don't know, some of these estimates in here for like 100,000 down from 187, that would be a huge drop off.
Mhm. I mean, as far as weakness in the labor market, let's remember that the labor market is a lagging indicator. So a lot of people put so much, kind of credence into every month's jobs report and the fact that it's strong and the Fed's going to have to do so much more. Let's just remember it's a lagging indicator. It is what's kept the economy afloat for this entire year. But going forward, there are some cracks that are starting to emerge. When you look at some of the underlying indicators and some of the indexes in manufacturing or even the service side, this is showing weakness. We know that from the construction side, there's weakness there with the housing market being in such disarray. So I don't necessarily think that, from the weakness in the labor market will continue to materialize. It's just not going to materialize immediately. Also, we do in reality have a structural issue with the labor market right now. We have some demographics that are concerning, but I do think if you look over a long period of time, so I'm not talking about this month or next month, there are other things that we have to remember, like AI. This will come in and also help with some of the structural issues in the labor market. I just think it's going to make the Fed's job very difficult, and they're going to have to tread very lightly with this. Unfortunately, it looks like they're going to push the economy into a recession, a needed recession. There are some excesses that need to be cleared out, but unfortunately, with the amount of tightening that they're doing and that they need to do, it's likely pushing the economy into a recession.
Oh boy. All right. So I had taken recession off the table, Megan, 3 months ago. So we'll have to see how that plays out. But I trust your opinion a lot more than mine. Looking at the S&P 500, Megan, we're still up 10% for the year, but down 8% or so from that high back in July or so. Has the market adequately priced in higher for longer, or do we have more to go, or are we going to tread water? How do you kind of view the next 3 to 6 months?
I still don't think it's completely over. I think a lot of it has been done, the damage. We've seen this has been a pretty rapid move. I just don't think from a valuation perspective, there's two things. I think PE multiples still are a little too high, given the higher for longer. And I also don't think, I know you mentioned you took recession off the table 3 months ago. We've kind of always been in the camp that there'd be a recession, but now there's more people coming back into the camp that unfortunately this will end in a recession, whether it's a short and shallow recession, but some sort of a recession. The earnings expectations for next year aren't really reflecting that yet. So I'm afraid that we're going to see earnings expectations come down lower for next year. So that could put some more downward pressure on the market.
There's still so much division within the Fed right now of where do we go from here. And, I want to ask, and Megan, maybe you've got a better idea than they do right now of what the data is telling you in terms of the direction of rates right now. You think another hike may be possible this year?
Yeah, and I won't say I'm smarter than anybody at the Fed, but I will say that I think it is good to have some of the division there in the committee because we are walking such a fine line. Inflation is extraordinarily easy to reignite, especially if you start to give the signs that, hey, we are done, rate hikes are done, because then eventually people are going to be looking for that rate cut. What my concern is that rate cut isn't going to happen anytime soon because they're walking such a fine line with inflation. With the PCE core, we did just get below 4% on a year-over-year basis. That's good. Inflation is going in the right direction, but there are some other factors that we're concerned will just cause a lot of volatility in inflation and make us getting from that 4 or 5% inflation down to 2% much more difficult.